Hello, everyone, and welcome to my YouTube channel. What a fantastic day it is to talk about the markets, because markets are booming and everybody's talking about a correction that seems to never happen. So who better to talk about all of this than Michael Gayed? He is the founder of Risk On, Risk Off, and also the portfolio manager at RORO Investments. How are you, Michael?
I'm good. I got to tell you, I'm a big fan of yours, Daniel, so I'm glad we can do this.
Thank you so much. You're very kind. One of the things that so many people in our YouTube channel and in my website ask about is the current situation of markets, because everybody's talking about a possible correction, or whether this booming environment is going to continue. And you are someone that actually is consistently looking at the different elements that lead to have a better understanding about the moment in which we are in terms of markets. What is your general view about the market environment right now?
So, look, I think you use the right word, which is elements, right? Because I always say that I don't know the exact mile marker I might crash my car,
Yeah.
but I know the conditions, I know the elements under which an accident is likely to occur. Nobody can forecast the future, right? The best I can tell you about is the weather. So in terms of the content and all the research that I do, I always try to frame things in terms of trying to give voice to math, looking at leading indicators, at least historical leading indicators to volatility, to the conditions. The 5 different research studies that I've put out since 2014, which all want separate awards, all document different leading indicators. And most of those leading indicators are leading because they are sensitive to interest rates.
Sure.
So the 2014 Dow Award paper, right, documents the idea that utilities, as the most bond-like sector of the stock market, tends to move ahead of major crashes, corrections, bear markets. Same deal with treasuries with the yield curve. And then on my pinned tweet, which I saw you retweeted a little bit earlier, the relationship of lumber relative to gold. Now, typically, prior to major declines, you will see all of these interest rate sensitive relationships behaving the same way. Yeah. Meaning prior to every single major tail event, you see utility strong, you see treasury strong, you see lumber to gold weak. And you're getting to a point, at least kind of near term, where a lot of those are seemingly suggesting that we're entering a risk off condition. Now, keep in mind, we have to define what risk off means, because I think the media often gets this wrong. I can't tell you how many times I hear people say when the market is up, it's a risk on day, or the market's down, it's a risk off day. Risk on, risk off to me is about changing volatility dynamics. Risk on is lower average stock market volatility. Risk off is higher average stock market volatility. And that matters because it's in those higher volatility states when you tend to have the accidents. Lumber to gold has been cratering since early May. Utilities against the market look bombed out. And we know that the yield curve looks like it wants to keep on flattening, given that yields topped out mid-March on the 10-year. So you look at all those dynamics, and then you say to yourself, okay, you got trillions of dollars of stimulus, and yet despite trillions of dollars of stimulus, U.S. small caps have gone sideways since February. Emerging markets peaked first week of February. Yes, it looks like the headline averages are making quote unquote new highs, but it's on increasingly narrow leadership. Okay, so that's a little strange, because you have to look at the context under which markets are behaving. And then you say to yourself, okay, well, what other conditions are there for the accident? You got short interest as a percentage of market cap near levels not seen since the year 2000, meaning nobody wants to short, which makes sense, right? Because nobody wants to become the next Reddit victim as far as these short squeezes. You've got margin debt in equities at all-time highs, and that's not unusual. Markets hit new all-time highs, margin debt and confidence hits new all-time highs. And then you've got put-call ratios still hovering around, the low level of its range. So I look at all those dynamics, and meanwhile, everybody is still talking about the reflation trade, which has worked in certain areas, but is starting to unwind with commodities breaking down. So I'm saying all this because, the way I tend to look at markets is from an intermarket perspective. I try to see what's going on, not just within an asset class and across asset classes. It's my suggestion here that we probably are entering or are in right now some kind of a risk-off period. Now, whether that means you have a tail wagging, you only know with hindsight.
Yeah.
But at least in these kind of junctures, you need to slow down a bit.
Mm-hmm. One of the things that interests me, for example, about that, what you just mentioned about the reflation trade, is how, for example, net long positions from traders on commodities have come down significantly and very quickly. And that all has coincided with all those elements that you just outlined a few minutes ago, no? Peaking of emerging markets, you have the lumber to gold ratio starting to come the opposite way. And you have also signals, no, in small caps that tell you that that at least investor perception about the recovery is heavily discounted, no? And it also coincided with, in terms of macro environment, it also coincided with the moment in which the economic surprise index started also to be negative, which means that yes, data remains relatively bullish, but it's fully discounted or is slightly underwhelming relative to expectations. For most of our viewers, this period might look like a consolidation of a strengthening phase. No, what would you suggest would be the key points for our viewers to look at in order to discern whether it is actually a consolidation phase of a stronger trend or the unwinding of the reflation trade?
So there's a lot to unpack there, and I put on my Twitter account these videos of my father who did a lecture to Merrill Lynch brokers in the late '80s, and he has this sort of the psychology of a chart, and he shows that here's a chart on how markets tend to react, and here's how fundamentals look. And to your point, fundamentals lag the chart. So in other words, the market is supposed to be a discounting mechanism. Okay, now the thing that I think that's underappreciated when you think about commodities and markets in general is that mean reversion means you have to go past the mean.
Yeah.
Right. The only way we go, because so it's a lot of people talk about mean reversion. Mean reversion, I always say, is perhaps the most consistent thing in markets. If there's ever a thing that you could argue is guaranteed in quotes, mean reversion is probably it. And mean reversion is just another way of saying there's cycles, and obviously means change, which is what makes it more difficult. But from a mean reversion perspective, you can't just go back to the prior range, because if you stop at the prior range, in the example of lumber, well, now the mean is higher, even though it's supposed to be lower, right, historically. So, so there's two ways to look at what's happening in commodities and then this consolidation phase in markets. One is you can say, well, a lot of the movement in commodities and these other leading area indicators and areas of the marketplace, that they're towards the end of their own weakness, because it's already been fairly sharp. It's taken a bit of time. Maybe the correction in commodities and some of these other reflation trades is over, in which case they start to come back, maybe, and that might be supportive of risk on equity assets. Completely possible. But again, if the only way you have mean reversion is to go past the mean, I would actually suggest that maybe it's not over, right? That you could still have further unwinds. And I think this is also something that's structurally underappreciated by market participants. Why do markets overreact? They overreact not just because of behavior, but because of leverage.
Gotcha.
Right? When you have a lot of leverage in any asset class, and there's these kind of global margin calls that happen, you keep having sell-offs because you have to keep on raising collateral, okay, or reducing your debt. So I look at that again, structure of the markets here. I still think there's a tremendous amount of leverage. Now, you can argue that part of the cryptocurrency crash was driven by leverage.
Yeah,
I don't think that leverage is fully out by any means. I think you can make the same case for commodities. I don't think leverage is fully gone either. So I still think there's a bit of an unwind. Now, look, again, even if it is a consolidation period, as you know, there's two types of corrections. One correction is in price, the other one is in time, which is an opportunity cost correction. Maybe it is the latter. But again, I go back to I always use this line on Twitter: opportunity always exists when the crowd thinks it knows an unknowable future. I think there's a tremendous amount of overconfidence in the reflation trade still in equities, even though other areas have now expressed that doubt. And if equities suddenly start to realize the message of every other part of the investment landscape, that to me more argues for a correction in price, not time.
Yeah, that is very important because what we get from the consensus analysts, from the different brokers, etc., remains extremely confident in terms of the earnings profile of the main equity indices, in terms of margin expansion. But as inflation creeps up into prices, into input prices, and margins start to suffer in that environment, with that many of those estimates are going to be revised downwards significantly.
Yeah, and riffing on that real quick. So I'm glad you mentioned, because that's an interesting point. Which, and I've been making this point in media appearances and in writings. So in relation to the reflation trade, right? So the argument is that commodities are a form of cost push inflation. So that means that inflationary pressures rise, inflation expectations pick up, as we've seen. But to your point about margins, what I think missed in that discussion around commodities as a form of cost push inflation is the speed with which commodities move. Right. So in the case of lumber, as an example, here in the States, lumber went vertical. I can't tell you how many people around me, friends, family, some of them are contractors. They say, I can't tell you how many clients are now canceling their projects because they were going to replace their wood fence, but it's just crazy expensive now. So I would argue that if commodity prices are rising gradually, that's more of a reflationary type of secular trend, because it would suggest that companies now expect, because of recency bias, that prices will keep going up. They start passing down those prices to the end consumer. Consumers start preparing for that and expecting it. If the move is too sharp, though, there's not enough time for companies and for individuals to react in terms of, not just the pricing function, but also the buying side. So in many ways, I would actually argue that the commodity move has in some ways been deflationary, not inflationary, because of the speed with which it happened, right? And you start to see that now in the economic data weakening.
Yeah, that's a very good point, because in many cases, one of the risks that you find is that a very abrupt increase in prices does not generate the type of structural move up in the economy, in terms of the companies investing a little bit more, buyers being confident that those prices are structural, etc. When inflation goes up so quickly, usually what it leads is investors to be more prudent about their capital expenditure decisions. Consumers get hurt in their day-to-day purchases, so therefore they become also more conservative. And it's an interesting point what you're mentioning, because the speed of the increase in prices has not been adequately explained in markets, particularly in this last period. Everybody's talking about inflation, whether the inflation trend is transitory or not, but nobody is saying, look, when it goes up so fast, it generates a very difficult and deflationary environment afterwards. We saw that in 2008 with oil prices, when they shot to 130, and everything just generated a deflationary spiral afterwards. So do you think that is something that we can sort of put close together, the 2008 example of inflation relative to the obviously latter part, including the leverage that you mentioned?
Yeah, no, and even just circling back on that idea, I mean, the reason why all that ends up being deflationary is because everything you just referenced is about the velocity of money dropping.
Yeah.
Right. That's why it ends up being that's sort of the causal effect there. So and I know you've done some work on this too. Most major big declines also tend to be preceded by oil spikes.
Yeah.
Well, oil is starting to kind of get into that territory where you can argue there's an oil spike. Again, it's not a guarantee. It's it's kind of like when people say that the stock market has predicted 9 out of the last 5 recessions. Like that used to be a saying back in the day. That's okay, because there are always going to be false signals in any indicator, in any relationship. Maybe the oil price spike this time doesn't mean you're going to have a recession. Maybe the speed with which commodities have run actually will be inflationary, even though I would argue it's more likely to be disinflationary. But again, because you can only live forward and you can only look backwards, you have to be very aware of these types of relationships in the moment, in the small sample, just to figure out how to allocate. And look, I mean, we're both portfolio managers, right? I run an ETF, RORO, and a mutual fund, and these risk on, risk off approaches. You run funds as well. We don't choose the cards we're dealt. All right, we choose to play the game. right? So the question then, of course, becomes, well, what do you do about this dynamic, this inflation deflation dynamic? And there's two sort of extremes in terms of how to think about it. One is you could take sort of a risk parity approach, right? Meaning that you have exposure to multiple asset classes that all will react differently, but all will likely work at some point. So if something's not working, stocks are not working, maybe gold is working, maybe treasuries are working, right? Or you take, a much more active stance. In my case, risk on, risk off, all in equities, all in treasuries, and try to get a couple of home runs.
Yeah.
Right? And both of them are very hard, right? Because you and I both know FOMO, fear of missing out, is a very real phenomenon, right? Nobody tends to think about the historical context of oil price spikes or lumber crashing and commodities breaking down. Nobody seems to care about that when they keep hearing about their neighbors making more money in the S&P than they are not being in the S&P.
Yeah.
Nature of the beast.
No, completely. One of the interesting elements as well there is the portfolio composition. No? Is how do you prepare yourself, or at least generate some backstops in a portfolio in order to address a possible correction without being completely out or completely exposed to that risk event, to that risk off event. And you mentioned gold. The US dollar is strengthening. We've seen the largest reduction in short positions in the dollar in the last week since 2006, according to Morgan Stanley. We have seen as well that the value relative to growth stocks dynamic has changed. How do you see those in terms of building a portfolio that can address at least a short-term correction without being completely outside of the market?
Yeah, so this is I love this question because it's actually a lot more nuanced I think than people think. Okay, look, every single portfolio, every single strategy is a function of three things. One is the signal, what you're determining to allocate, with. Two is the look back period, meaning let's say you use a moving average, maybe 200-day, maybe 50-day, but what's the look back period that you're evaluating the signal over on a rolling basis? And just as important is the opportunity set. How do you execute on a particular viewpoint? Now, I come from the school of thought that there's really only two asset classes. Those that benefit from low volatility, those that benefit from high volatility. The world runs and progress is driven by low volatility assets, which means that if you think about risk off plays, there are not that many that you can choose from. To your point, historically, it's gold, it's the dollar, and the one that's most consistent and persistent is treasuries, right? During those flight to safety trades. By the way, none of those are holdings that traditional financial advisors want to touch at all from a buy and hold perspective, even though they are arguably your ultimate diversifiers, right? So, okay, so given that context, and by the way, why am I not including shorting in that? So you and I both know these studies that show that market timing doesn't work. I agree 100% with that. And that sounds a little strange because I'm running funds that go all in, all out, all in equities, all in treasuries, risk on, risk off, using these indicators, rules-based. Well, I agree that market timing doesn't work because if your opportunity set doesn't allow you to be wrong and make money, you're going to fail miserably. You do any kind of back test where the risk off trade is cash or shorting, you will see your back test fails miserably. Why? Because neither cash nor shorting allows you to be wrong and make money. If you're shorting, you have to be dead on timing wise. If you're in cash, you have no chance at compounding. If, however, you're in treasuries as your expression of risk off, you might make money, you might lose money, but you're not guaranteed to lose money. You have a chance at making money expressing a defensive risk off trade for a moment in time. Gold fits the same kind of characteristic. Dollar fits the same kind of characteristic. Low beta sectors like utilities, staples, healthcare also fit that as well. So, I think treasuries, as unpopular of an asset class as they are now, probably are what make the most sense. Just if anything, because of that historical risk off flight to safety potential. And candidly, even though you haven't had any volatility in the stock market just yet, treasuries have done just fine. You've made money if you've held on to treasuries for at least a few months here.
many of the investors in countries outside of the United States, most of the foreign investors are going to be looking at treasuries to buy in an environment of not only correction, but trying to find some ways to cushion the blow of changes in the positioning. However, you also mentioned leverage. Do you think that the level of extreme leverage that we're seeing right now can play an important part in making it more difficult for investors to simply switch out of emerging or European equities into treasuries?
You know, it's interesting because that's, I mean, partially you can argue that what's going on with the Fed's reverse repos is an example of kind of that problem that there's not enough collateral, right? Which is, you know, why they're trying to liquefy the banking system with treasury bills. So, and that actually makes the argument for why yields probably keep falling, because again, of those three, the dollar treasuries and gold treasuries are the most liquid and biggest market from a speed perspective. Now, and by the way, you know, what you're arguing makes a lot of sense, right? Because even though oftentimes I tend to look from a very U.S. centric perspective in terms of risk on, risk off, we know that when there's high volatility in the U.S. markets, international markets also co-move in a very aggressive way, right? We know that the 87 crash was not just a US-based phenomenon. We know that pretty much every single major US-based decline also resulted in tails wagging overseas. So yes, I do think it makes sense that you would see demand from foreign buyers. Now, the complicating factor there is, okay, well, what if Bitcoin or cryptocurrencies enter the opportunity set at some point as a potential risk-off play, which we're not there yet. I mean, clearly, you know, I would argue that Bitcoin and other cryptocurrencies are just a levered beta trade for the most part. But maybe at some point, if that technology, if that demand changes in the reasons for why cryptocurrencies are bought, maybe then that lessens some of the demand for treasuries and gold, because now you've got this other sort of area to play safe haven with for a moment in time. But, you know, real quick on that leverage point, I'm a big fan of Nassim Taleb. Right? Yeah, Black Swan, anti-fragile, anti-fragility, and I think correctly so. He would make the argument that leverage is how you get black swans, right? And the more leverage you have, the more these 1 in 1,000 year events happen closer in time to each other, right? So, and perversely, you know, you're in a situation now where it's almost this kind of feedback loop, because you get an extreme decline, you get a tail event, you get a black swan, the Fed liquefies, they encourage more debt, which creates more fragility, which creates the potential for another black swan, and then it gets bigger and bigger. So we keep seeing the frequency of these large tail events happening more and more, because the debt monster is so big in the response to the prior black swans that would happen, right? And again, all that means is, from a perspective of how do you manage through that, those are the cards you're dealt, you've got to consider more and more diversifiers in a portfolio. The problem, I think, is that a lot of people think diversification is 500 stocks. They think diversification is 5 stocks, which is the FANGs, right? Or you know, the reality is most things tend to move off of beta. They're just, you know, beta dressed differently, right? So whether you're international or you're domestic, my point here is that if you are concerned about a decline, the way to do it is to be in the area which nobody wants to touch. Treasuries, gold, the dollar, the stuff which has not worked probably starts to, because nobody seems to think it will.
Exactly. I always make the comparison to our clients, saying that in a portfolio, especially when you have to be fully invested all the time, like we are, you need to have goalkeepers, you have to, and you need to have defense, no, using soccer similarities, and that it's gold and the US dollar that generate that level of defense in a portfolio. Another important thing that you've mentioned about leverage and the occurrence of black swans is that they become more frequent. One of the problems that or at least that I identify in the many of the questions that people send to us, is that they sort of look at the previous crisis and think, well, there's still like 5 years in front of us before we see any other crisis. But crises are more frequent. They're less abrupt, but they are more frequent. When what would you identify apart from leverage as the elements to look at before, at least to position yourself a little bit more on the defense side?
So there used to be this old indicator, which I'm sure you're familiar with, called the odd lot indicator.
Yeah.
Right. So the argument, this is back in the 80s and decades prior, is that when you see a lot of small shares being put in odd lots under 100 shares, which would probably come more from retail clients that don't have necessarily as much assets as the institutional clients, obviously, that tends to be sort of a signal that everyone and their brother is buying a particular stock.
Gotcha.
And that it's actually a contrarian signal, right? Now, obviously, you don't have the same dynamic with odd lots anymore, because now you can have fractional lots, right, with the way market structures and dynamics are. But I do wonder to myself, if what we're seeing with Reddit and the quote unquote resurgence of retail traders and investors, if that's a contrarian signal that you can't necessarily quantify, but you can kind of see as sort of being the early signs of trouble in markets. I've used this line before on Twitter at the Lag Report, and I have a large number of followers, and I can kind of see what the sentiment is. The level of uneducated speculation going on in markets is really astounding.
Absolutely.
And I think it's very underappreciated also by the media and financial institutions. You have a lot of people that are trading this without knowing at all what the rules of the game are, that are taking immense risk and thinking they're geniuses because of the small sample, the single roll of the die, without even knowing what a call option is, right? And look, I'm all for broad participation, and I'm all for people being involved in trying to enhance their personal wealth, but it's not a game. It's like everything else in life. You have to study. You have to take it seriously. It's not something to just gamble with. And I think we can look back at this period. I think a year from now, we're going to look back at this period and say the signs were all there. Aside from the fact that the leverage is as extreme in the system as it is, the type of behavior by the end investors, by these smaller, the new odd lot, so to speak, which is really what I'm arguing is the Reddit traders, that was the sign that something bad was coming.
Yeah. I remember that in 2007, when I was at Citadel, we used to mention that the massive short squeezes in bankrupt companies and bankrupt construction and banks in Europe were a signal of extreme complacency, and the idea that retail investors would jump into the stocks in which you had the combination of trying to generate a short squeeze, at the same time some conspiracy theories about the Russians or the Chinese are going to buy this company, generated these elevated valuations that deflated very rapidly afterwards. But I think that when I address these comments, one of the things that our viewers immediately say is, oh, but this time is different because central banks will not allow a monster liquidity crash, and therefore there's only one game to play. What would you say to those people that basically think that central banks are going to bail you out of any bad investment decision?
Well, look, I mean, history has proven them right, but keep in mind, like, this notion that's kind of related to this line that you always hear, which is "Don't fight the Fed."
Yeah.
Don't fight the Fed. Well, what does that really mean? Don't fight the Fed. So they lower rates from 2002, and the market still crashes. The lower rates starting, I think it was early 07, right? And then obviously 08, and then market still crashed. Even with the COVID crash, they kept on doing every single other day. They were doing some new liquidity measure. The market still crashed. Now, at some point, the market bottoms out, and then everyone says, well, don't fight the Fed because the Fed happened to do just enough this time.
Yeah.
But to me, that's kind of a strange concept. If you're going to be a true buy and hold investor, you're probably going to be right. It doesn't matter. But the reality is, people tend to react off of the sequence of returns.
Mm-hmm.
So this kind of joke about buy and hold is that nobody holds.
Right? Exactly.
The average holding period, and that's probably why buy and hold works. By the way, I mean, if you think about if you almost consider buy and hold like an anomaly, right? In many ways, because it works over the long term. The reason it works is because there are not that many people arbitraging it because everyone's always constantly over trading. I mean, that's just sort of taking to another extreme on that end. So I do think because nobody tends to hold, because the average holding periods tend to get shorter and shorter, you have to worry about the market movement because it might impact your behavior.
Yeah.
And that will not have negative impact and movement on your own portfolio.
That is a very good point. I always say to the people that follow us that the concept of don't fight the Fed only works with the S&P 500 and right. US stocks, because you can fight the ECB anytime you want, because the European stock market has been an absolute train wreck in an environment of absolutely unprecedented levels of liquidity and negative interest rates. No, so be very careful about, to all our viewers, be very careful about believing in central banks as this magic wand if there's not something that is behind all of that is going to maintain elevated valuations, which probably brings us to one of our second to last questions. Buybacks. No, buybacks are holding the market significantly. They've been an integral part of the behavior of the S&P 500. What is your general view about buybacks? Because, for example, this year buybacks have come down quite significantly, yet the market isn't doing so badly. What is your view about how to trade with the buyback figures?
Yeah, well, I mean, and buybacks, as you alluded to, have been a big tailwind for a decade plus. Right. I mean, you can argue that I've seen studies that would suggest that a large part of the reason why you have this big disparity between U.S. markets and emerging markets is because in U.S. markets, they buy back stock. In emerging markets, they don't, right? So aside from
emerging markets, they sell stock. Huh?
Right, exactly, right. So it's a different. So I mean, so there's no question that that's been beneficial and helpful. I do wonder though if, just given the political climate in the U.S., if you will get some pressure to maybe put some barriers in place or make it harder for companies to do buybacks. There, especially when COVID happened and everyone was basically yelling and screaming, saying you're bailing out all these airlines. How can you allow that to happen when they keep on buying back stock? There actually is a valid argument there that there's sort of this unfairness, I think, to the way that corporations are basically buying back their own shares, but then when it's a crisis, it's systemic, so you got to give us funds. All their CEOs are getting super rich, right? So I do wonder if that's going to be kind of down the line. Again, these are dynamics in the marketplace, but why are they buying back stock? Because interest rates are so low, right? So historically, buybacks were meant to be more of a signal that corporations were confident in their future, their NPV projections, right? So that changed with zero interest rate policy. Now it was more about financial engineering, so that, well, if money is free, well, then let me pump up the stock price, not because of better growth prospects, but because it's free and the CEOs and corporate executives can better enrich themselves because of their own holdings in their own company. Again, it's helped the market, right? But it's not, I think, as much of a signal as it used to be.
Agree with that. Yeah, no, I completely agree with that. The other thing that is a signal of the overall economy is that when companies increase the share buybacks, it's also because they don't have organic opportunities to continue to grow the business and invest further. That's another signal of overcapacity, low productivity, and as you mentioned before, which is an integral part of the dynamic in the economy, very low velocity of money, is that you can have massive increase in money supply, but very low velocity of money because low rates and high liquidity perpetuate overcapacity, and companies simply don't find organic opportunities. But this is our last question. They do find inorganic opportunities precisely because of high liquidity and low rates. And M&A transactions are at an all-time high. Do you think that is a bullish or a bearish signal?
Yes, meaning it's both.
Yeah,
right. Because to your point, right? It's you can't get organic growth, so you got to acquire and take out other players. So you can argue that that's bearish because it's kind of like, well, there's nothing else to do, so just go on an acquisition spree. And at some point, the number of companies you can acquire lessens to the point where there's not much else to look for. So I think there's an element of truth to that it's bullish short term, right? But maybe kind of more of a tell about the system in general. But I want to I want to end off a question to you because I'm kind of curious
Absolutely.
on this thought because you mentioned the velocity of money. So I've long held this belief that this is a game of psychology.
Mm-hmm.
Right. The problem I think the Fed has is that they are very poor at understanding behavior and psychology. Meaning, if you want to pick up inflation in a sustained secular way, clearly it's not with more money printing. It has to be with more transactions. It has to be with the velocity of money picking up. It seems to me that the only way you can do that is by threatening higher rates.
Mm-hmm.
So
Absolutely.
which is almost contrarian to the way most people would think about how do you create inflation. It's not by liquefying, it's by trying to create urgency. Do you think there's validity to that argument that if the Fed were to say, you know what, no matter what, we're going to start raising rates, we're going to apply something like Taylor rules, some kind of rules based approach, and that way it's going to happen, and you better start borrowing at these low rates now? Do you think that could change the secular? Because I know, like me, I think you're more in that sort of longer term deflationist camp.
Yeah, no, absolutely. One of the things that the Fed and central banks in general now understand is that their policy is deflationary because it perpetuates overcapacity. But the problem is that they are so hostage to their own policy because governments simply cannot even tolerate a very mild increase in yields that they cannot change it. That's why the level of agreement between Fed officials is so high. The people that sort of analyze the writings of Irving Fisher, that they say that if you want companies, if you want the economy to strengthen, what you need to do is to hike rates. Hiking rates would actually do two things. First, reduce the risk of perpetuating overcapacity and bailing out indirectly the inefficient, but also generate a higher level of productivity growth. And there's clearly a school that follows Irving Fisher, the old economist, that says so. However, what is unfortunately populating the economists around central banks and governments is more neo-Keynesian that thinks that, well, as long if the private sector is not investing and consumers are not taking more credit, then what we need to do is bloat the government and make government do it and the public sector do it, which is a big mistake. But there is absolutely a rationale behind thinking that in an environment in which the economy has already passed the risk of liquidity crisis, you raise rates and improve the economic situation and the productivity environment. Absolutely, it is.
Yeah. I suspect that will never happen.
And I suspect that it is very unlikely to happen. That's why the risk of entering into a deflationary spiral like the one you mentioned after this inflationary spike is very high, because when you as a central bank have no option. Think about this: the European Central Bank intervened in the market massively in between March and April of this year because of a very modest increase in yields of the peripheral countries, who were all of them still financing themselves at negative real and nominal rates. So imagine how hostage they are to their own policy, and that's why probably it will not happen, and we will likely to see what you just said. Michael, we've spent a great deal of time, but I think that our viewers are going to get a lot from what you have said. I think that there are very important messages. I think also that all of you that are watching, you should follow Michael. All the details to follow him, you can find them in the details of the video below. Thank you so much for your time. It's been an absolute pleasure.
Thank you, Daniel. Really appreciate it.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.